Hey, are you wondering if right now is a good time to buy, or should you wait a little bit, hoping the rates might come down? Well, we are going to have a fabulous conversation with Harold Smith with Legacy Mutual and answer that question for you. We're Mark and Tamara, and we're here to empower you and help you make the best decision in real estate.
We're here with Harold Smith with Legacy Mutual Mortgage, and we were talking about, is it a good time to buy? So it's a question we get a lot, right? Should I wait for interest rates to drop before I buy?
Yeah, nobody says, should I wait until they go up?
No.
Right? I've never heard that question. It's a good, yeah. And I mean, here's the good news. We've talked about this a little bit. Here it is. It's early January of 2024. They actually have improved a little bit from where they were just a month or two ago. We're not to where they were in 2020, 2021. And I usually...
They're probably going to not see those.
Yeah. I tell clients to say it took a worldwide pandemic to get there. I'm kind of done with that. But a lot of people forget that shortly before COVID, rates were in the upper threes, low to mid fours. Mm-hmm. So I don't know that we'll go back there that quickly, but they have improved a little bit.
Yeah. So it kind of all depends on your perspective, right? It's like where you've come from.
It does. Because, and I know y'all have had clients who bought homes back in the late 70s, early 80s.
Right.
And they say, because we will hear this, they'll say, oh, I remember when rates were 15, 16, 17%.
18% even.
Yeah. So it's a fair question. We're here in Dallas where we have a lot of people still moving here. Every year, U-Haul comes out with a report. What's the number one inbound state? And it's Texas.
Wow.
It has been for the last 3 years. That's part of why we have a good, healthy economy here. As rates lower, we'll just probably see more buyers enter the market, most likely.
Right.
So the people who have been renting and they're like, okay, we'll do it now. So you might have more competition, but yes, you might have a lower payment. What does more competition do? We saw this especially during COVID. Prices rose. They rose a lot.
Because our supply is still not as high as it could be.
It's exactly right.
Yeah.
It's exactly right.
Some people that got 2 and 3% rates and they're not wanting to give up their
That's right. There's going to be that group as well. That's right. And some people, but they're building new homes. They are. Where are those new homes?
Yeah.
Way out there.
Right.
Van Olstein, Anna. I mean, I know there's other examples, but they're a little further, and that's not where everybody wants to live necessarily.
And I do think we have a lot of pent-up buyer demand. Like they're waiting for the rates to drop, and I am worried that if everybody waits, then it's going to increase prices.
Yeah. So here's what I tell clients to that question, because it's a valid question. I say, look, we will help you whenever, but here's a certain thought to give. Let's say you bought now. Mm-hmm. Right now, rates are, let's say, low to mid sixes. You're able to get a good price on it, make that offer, and you own the house. Great. And as long as, of course, we got to qualify. That's a given. Let's say in a year or 2 years, rates fell to 4%. What are we going to do? We're going to refinance.
Yeah.
We're going to watch, and if it makes sense, and we think we're going to be in the house long enough, and there's some math we do to run that, we'll refinance and we'll take advantage of it then. I kind of tease clients. I go, in 2020 and in 2021, when we had a lot of refinances, there was one thing every single one of those clients had in common. They owned a house. You can't refinance a house you don't own.
That's right.
Okay, well, let's say, though, that you bought and say the rate was 6.5. And what if the economy doesn't get stronger?
Mm-hmm.
What if rates went to 7.5, 8, 9? You're going to be so glad you have 6.5.
Right.
So don't try to time it with the rate. That's not the right way to go about it. What I tell people is, if you feel like you want to buy a house and you qualify, go buy a house. And the big thing is, then you start to get that appreciation.
Mm-hmm.
As long as you're renting, your landlord's getting their appreciation. That appreciation is the best friend. It is the best friend of the homeowner. Because this is where we've seen clients who bought a home, they were first-time home buyers, they could only do 3 or 5% down. That's all they could do. And then they live there 3 or 4 or 5 years, and they sell it, and they're like, oh my gosh, that's the biggest check I've ever seen in my life.
Yeah.
It's game changing. It's wealth building.
Yeah. It is wealth building.
Now, if someone is nervous about interest rates right now, obviously we've talked about this, there's programs that they could take advantage of.
Yeah.
They're called typically buy down programs, 2, 1, 3. Can you just explain that briefly?
For sure. That word buy down gets used in a couple of different ways. There is what's called a permanent buy down, where somebody has a little more closing costs to lower their interest rate some for the long haul. And so, like, let's say right now, like I have a client I was mentioning to y'all that is going to close next week, and their rate is going to be 5.75. They brought some extra closing costs to bring that rate down permanently. Okay. That's called a buy down, but it's in the form of what's called paying discount points.
Right.
Okay. And by the way, 1 point is 1% of the loan amount. There's half points and quarter points, things like that.
Mm-hmm.
But what Mark's talking about is a concept that you'll hear about from time to time called a 2-1 buy down. There's also a 3-2-1 buy down, and there's a 1-0 buy down. And so let's just say that the rate right now is 6.5. Keep it simple. So we'll start with a 3-2-1 buy down. What would happen is it stair steps. The first year, the rate is 3% lower. The second year, it's 2% lower. The third year, it's 1% lower. And then the fourth year, it just goes to that rate that it stays at. So if rate right now is 6.5, that would mean it would be 3.5, 4.5, 5.5, 6.5. 1 year in each of those increments. Well, the way that works is it has to be paid for by the seller. That's not a rule we have. It's a Fannie Mae, Freddie Mac rule, FHA as well, and VA, that the seller pays that cost of the difference in the rate. Okay. And the buyer, our client, will have a lower payment year 1, and then it stair steps up a little bit in year 2, and then year 3, and then it gets to that permanent rate. Kind of sounds really great because you'll have a really low payment initially.
Right.
Okay. That's great. But if rates were to improve, maybe you're better. It's all depends on what we think is going to happen with rates.
Right.
That's really the crux of it. Is if rates were to go higher, well, that would probably be a pretty good option. But if we think that rates are going to go down, maybe we don't want to do that. We just want to grab a rate, not have all those closing costs, and we'll just plan to refinance in a year or 2.
Right.
So it just depends. And some clients, that having that lower payment is just super important to them, and that's fine.
Now, let's say you had that. Let's say 10,000. Let's use that as a nice round number. We got from the seller contribution to do a temporary buy down. What if halfway through those first couple of years, rates dropped, and they said, "Yeah, it's a great idea to refinance. I think we should go ahead." But they didn't use up all that money. What happens to that?
Yes. What Mark's referencing is that this money that the seller contributes when there's that temporary buy down, it kind of goes into a little pot. And that as every month, that pot is pulled from, because the payment is actually made at that final rate, like if it was 6.5. But you as the buyer only paid 4.5, then 5.5, and then got to the 6.5. So what Mark's referencing is, what if at 18 months, a year and a half, we saw a really great opportunity to refinance, but we hadn't used up all that money.
Yeah.
The good news is Fannie Mae and Freddie Mac and FHA have set it up that whatever balance is in that pot is used as a principal reduction. So they don't lose it.
Oh, that's nice.
So it's not that it's going to be a ton of money, but then it just, when we refinance it, it just lowers the loan balance. So they don't lose it.
Yeah, that's
okay.
Good news.
Yeah.
Correct me if I'm saying this wrong, is that one, you have to qualify still.
Got to qualify at that higher rate. That's exactly right. Good point.
And then the money that goes towards that buy down has to come from the seller.
Correct.
The buyer can't provide that.
Correct.
Money, right.
So this is where, I know we've run into this before, where if it's a house that, and even here in Dallas, if a house goes on the market, it's in a great area, priced about right, looks really good, we're probably not going to have that kind of ammunition.
Right.
Seller's not going to do it. So it doesn't work all the time.
Doesn't work all the time. But there are enough scenarios now where we have been in this kind of transition with the interest rates, and buyers kind of being a little hesitant. And we have found that some sellers are out there and they're willing to offer that. They're willing to say, hey, let's get this deal done. Yeah. And that's part of our job, is making those negotiations happen.
Absolutely.
And trying to get that money. Yeah. And I guess the point being in all this discussion is there's options, right? There's a lot of things that people probably don't think about and not going to until they talk to you or talk to us. And those options are, and that can get you into that home ownership and start to earn that equity.
Yeah.
Thanks again, Hal.
You bet. Thank you.
Yeah, this has been fun. So I've enjoyed it. It's great information. And if you have any questions, please get a hold of us.
Yeah.
Thanks.
Bye-bye.